Investors didn't wait long before rushing back into technology stocks after a very brief sell-off triggered by the stronger than expected US jobs data and some concerns about AI-related demand. But the rebound today reinforces the view that markets remain heavily dependent on the AI narrative, where every dip is very quickly attracting fresh buyers. While on the other hand, hopes of a ceasefire between Iran and Israel helped ease oil prices and yields yesterday, underlying energy risks remain largely ignored by global investors. And I understand because SpaceX headlines are certainly way more exciting than news of a burning planet. So, welcome to Swissquote's daily market talk. It's Tuesday, 9th of June. I'm İpek Özkardeşkaya. We will talk about technology and the rest. But before we do, and as always, please keep in mind that opinions are my own and this is not financial advice.
This show is brought to you by Swissquote.
So my major question yesterday was whether the technology rout that started on Friday on the back of a stronger than expected US jobs data and a few other news pointing that new technologies could eventually reduce the need for DRAM memory and AI safeguards could slow down AI adoption would be the beginning of a deeper and a much needed downside correction or not. Well, it turns out that it was just another blip. Technology stocks rebounded in the US session yesterday as deep buyers rushed in the continuation of the now usual dip rushing, which basically prevents dips from developing into healthy valuation resets. In this context, Nasdaq 100, for example, retreated a bit more than 5% since its June 3rd peak, following a 33% rally since April. And the S&P 500 fell a bit more than 3%, just 3% during the same period. We can't really call this dip or dip buying. Buyers are simply jumping on the back of a bull in the slightest occasion, and this is a huge and a historical rally. The occasion yesterday was the news that Iran and Israel would finally stop bombing each other after a bombful weekend. The latter pulled crude oil prices lower along with the US yields. US crude consolidates near $90 per barrel level this morning on hope that the latest ceasefire will work. But I can't stop myself from thinking that it won't, because the political setup today in Israel becomes increasingly more complex into elections there, and Mr. Netanyahu must show his population that he is ready to do anything for the security of the country. So to me, risks remain two-sided. We could see a further pullback in the short run in oil prices that could also pull global yields lower. But in the medium run, believing in an easy peace looks like a wishful thinking. So the big question is, how much longer can this market run on AI steroids? Well, no one has the answer, but the latest data warns that the global oil reserves have now dropped to the operational stress levels. And come September, the reserves will drop to the operational floor level, which is the minimum level required to keep pipelines functioning and refineries operating. The thing is, pricing across energy and risk markets are widely ignoring the energy crisis. So the risk is that the rally stops when there is no more fuel. For now, there is enough fuel in investors' minds though, at least for technology. Marvell Technology, yes, the one that Jensen Huang said would become the next trillion-dollar company, actually rose more than 9% in yesterday's trading session in the US after the announcement that it would enter the S&P 500 late last Friday. Korean Kospi Index also rose nearly 8% in today's trading session, with the SK Hynix jumping as much as 13%. And a day with a rise or a fall less than 5% in the Korean Kospi Index has actually become quite rare, to say how this market is volatile and hence how much a major part of the market moves that we see there is speculation. Indeed, Kospi's volatility index keeps rising to unbelievable levels, meaning that, warning that, when the music stops, there will be carnage. But anyway, that's not due for today. Today, we continue to observe the technology versus the non-technology narrative play out quite nicely, with technology attracting flows while the non-technology pockets of the global financial markets lagging behind. The news that OpenAI also filed for IPO is masking the ugly K-shaped economy where technology and technology-related parts of the global economy do well, shareholders do great as well, while the rest of the market and employees are struggling with rising borrowing costs and rising living and operating costs. And that also explains why investors cannot drop out of the market, because the abyss below looks far worse than the risks above. I mean, look, economic data yesterday showed that German factory orders dropped 3.8% last month, more than 2% expected by analysts, and mostly due to a more than 11% drop from the euro area orders. Alas, a benchmark for the European 10-year yield still rose on the back of higher oil prices yesterday in the European session, weighing on the STOXX 600 index as well, but that was before the peace news creeped in. Still, peace hopes or not, the Europeans are losing hope as the European Central Bank is now preparing to announce its first rate hike in almost 3 years this Thursday. And with limited exposure to technology, European indices are condemned to wait for the end of the Middle East conflict to claim their share of the cake. For now, cyclicals remain largely in the rear-view mirror, and while Europeans are mostly cyclical. As such, the euro-dollar is also falling out of grace these days, and that despite the relatively hawkish European Central Bank expectations. The 115 level here could act as a solid floor to the Iran-led weakness in the euro-dollar, if, of course, tensions in the Middle East ease and oil prices fall sustainably. If not, even the ECB rate hikes may not prevent the euro-dollar from slipping below the 115 mark on the back of the worsening euro area growth outlook due to the energy crisis. In Japan, the dollar-yen consolidates near the critical 160 level as traders are holding their breath every second to see if and when the Japanese officials would step in to stop the bleeding in the Japanese yen. The simple idea that Japan cannot let the dollar-yen rise further caps the upside potential for now. The softer US dollar could earn some more time for the Japanese authorities before they intervene, because it's costly to do so, so the more they wait, the better it is. But eventually, I believe that intervention in the dollar-yen will be inevitable. Elsewhere, Australian dollar is stronger today on the back of a broadly softer US dollar, but also on the back of strong trade data from China showing that both Chinese exports and imports rose 20 to 30% respectively in May. Chinese CSI 300 index is better a bit today, while appetite for the Hong Kong's technology-heavy Hang Seng index actually lags behind the Taiwanese and Korean peers. I firmly continue to believe that the Chinese technology rally will pick up momentum sometime, with AI infrastructure and physical AI shouldering the next leg up across the Chinese technology names. But Chinese capital markets must wait their turn when there are so many exciting US companies like SpaceX, OpenAI, and Anthropic preparing to go public starting from this week. So speaking of that, SpaceX IPO is reportedly oversubscribed, hinting that we will likely see a nice first day rally this week. That will certainly be followed by a period of valuation reset, but what will happen next will depend on the revenue outlook from the company. Google, for example, just signed an eye-watering deal where it will pay $920 million per month to SpaceX for 32 months to rent AI compute capacity from the company. As such, SpaceX has just become a major AI infrastructure provider almost overnight. Though that's going to be on Earth, unfortunately, as it's selling access to AI data centers that now sit inside SpaceX after the integration of xAI. But a few more customers like this and SpaceX stock could be actually headed for the moon before its rockets are. And Google, look at Google. Despite operating some of the world's largest data centers, the company still cannot build AI capacity fast enough on its own. To tell, maybe it's just not the stock market itself in a bubble, maybe the demand outlook is. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.